When I read your piece, I really couldn't help thinking about it as like a Succession prequel, how Logan Roy dished out, shares to his children to avoid taxes. So explain to us what it is, how it works, and how it can help sort of founders and VCs avoid taxes and their families.
Sure. So it was this tax break essentially created in the early 90s. The idea was to spur investment in small businesses. It was expanded right around after the financial crisis. But essentially, it's this $10 million tax break. It's called on this type of stock for early investors in a startup, a small business. A pretty wide amount qualify. But it's essentially, and you don't pay capital gains taxes on the first $10 million in profits. The thing is, as you said, imagine it's the Roy family, you can spread that benefit, and what it's called sometimes is peanut buttering. You can hand out this stock to family members, put it in trusts, and that can expand the benefit. You just multiply it. So that $10 million benefit, it can go up to that, it can become 30, 40, 50. You give it to children, you give it to a spouse. Mm-hmm. And it just becomes a more and more dramatic tax exemption.
Right. And Maureen, you did use in your article the real life example of Roblox, a CEO who, gifted tons of shares to family members ahead of the IPO and early on. But the whole idea of this, it rests on the premise, too, that the company has to become big. So the hard part is actually becoming successful. And with a lot of these taxes, we have to ask, if you take it away or you close that loophole, does that stifle innovation? Are there any kinds of those concerns within this?
It's a fair question. It's a very good question. It's hard to say. Sure. I mean, you have to wonder. I mean, would it really keep? I mean, we've seen this huge amount of wealth creation. I mean, it's basically been unprecedented what we've seen in the last few years from the IPOs, Lyft, Uber, Pinterest. Would it really stifle it? It's kind of hard to imagine, though you don't know. If it would,
one of the things I hear about a lot is sort of, there's concern about the rate of startup formation, right? Big companies tend to own everything, or there's a kill zone around them. Do you think taking this loophole away would increase the rate of startup formation, or do you think it's actually providing capital to startups or incentivizing providing capital to startups?
I mean, I think the idea was certainly incentivizing providing startup capital, but I mean, we've seen, I don't know how much this specifically incentivizes it. I mean, there's so much capital out there for startups. I mean, we're seeing it. If you look at VC firms, I mean, every single day, it seems like almost a VC firm. And that's exactly the VC firm's benefit, because you have to be an early investor in these companies to qualify for this tax break. And I mean, they're all raising almost record amounts of funds in a way we've almost never seen before, whether it's Sequoia or Tiger Global. Every day you hear of this record amount being raised to fund startups.
Maureen, I wonder how you think it fits with ongoing complaints about over-taxation in states like California. We've gotten comments like that from Elon Musk in the past couple of weeks.
That's an interesting point. I mean, because clearly we've seen so many stories about people leaving California for Texas, people leaving New York. I mean, California specifically, but also New York for Florida. So it is, I mean, there is a lot of taxation in California in particular, and this is a tax break that a lot of Silicon Valley companies can qualify for. But it's a small amount. I mean, you have to be in these companies early, either as a founder, an early employee, or a venture capitalist. So there's sort of different things, but it is an interesting point. And clearly it's been a hot topic lately, the taxes in California and this sort of migration out of state.